Welcome to the offering webinar for DFW Portfolio. Before we get started, I'd like to get our disclaimers out of the way. We're not offering legal advice. Do your own due diligence on the offering, and please read all offering docs that are provided in the deal room. Consult your tax and legal team. And lastly, we're just providing a general overview. I'd like to introduce you to our executive leadership team here at Spartan. Scott Lewis, our Chief Executive Officer. My name is Ryan Gibson, the Chief Investment Officer. And Ben Lapidus, our CFO, who will be speaking tonight on the feasibility and the financials of the investment. For those who would like to log in to our dashboard, please visit our website, www.spartan-investors.com. Click on our investor portal. You'll see it at the top right of the screen. And you can either create a username or use your existing login. And when you log in, you'll find the DFW investment under Open Investments. This is our deal room where you'll find all the financials, the PPM, and at the top right, you'll see Start Investment, which allows you to subscribe to the offering. As a reminder, wiring instructions are provided on this page. Please confirm all wires. We recommend verbal verification. You can contact one of our investor relation team members to do so. If you have any questions, please email investors@spartan-investors.com. You can use the Q&A feature on the Zoom, or you can send us a comment. Everyone should have an invitation to the investor dashboard by now, but if you don't, simply send us a message and we will send you an invite. Spartan also has a couple opportunities to meet the team in person in both Seattle and Denver. If you'd like to attend one of our events, just please let us know. We will also be in New York City and Washington, D.C. area in mid-September, and more details will follow. So the opportunity that we're discussing tonight is the DFW portfolio, and this is comprised of 18 value-add self-storage facilities in the greater Dallas-Fort Worth Metro and in East Texas. But before we dive into the details, I'd like to provide you just a little bit more background on the team at Spartan who will be carrying out all aspects of the investment. Just yesterday, Spartan was recognized for the second year in a row as one of America's fastest growing private companies. This year, we actually ranked 166, so congrats to the team. Spartan is primarily based in Golden, Colorado, with a satellite office in Seattle, Washington. The team handles the identification and acquisition of properties, raises capital primarily from individual investors, handles all aspects of property management under the FreeUp Storage national brand, and we perform the asset management. We also have an in-house construction company that builds our storage units and renovates our facilities. And lastly, we perform all business intelligence functions in-house for our investments. Spartan operates over 12,000 units, comprising $250 million in assets, has 55 employees, and is currently operating in 9 states with over 1.5 million square feet of storage. We currently operate 24 self-storage facilities under the FreeUp Storage national brand. In Texas alone, we operate 9 facilities and currently have a focus in the Dallas-Fort Worth and East Texas area. The acquisition of the DFW portfolio will increase our facility count to 27 in the area, centrally located in Dallas-Fort Worth Metroplex and in East Texas. This is a market that we've had a great deal of success in and have economies of scale. What we love about this opportunity is that we are in Dallas-Fort Worth market, which is the fastest growing city from 2010 to 2019. Spartan plans to add 160,000 square feet to the portfolio by building additional units in undersupplied markets that have high population growth. Due to the high occupancy at many of the facilities, the investment projects day one cash flow that we distribute monthly to our investors, and most, if not all, facilities have great drive-by traffic and great visibility from the main road. We have an attractive term sheet from our lender in the 3 to 3.25% range, with anywhere between 36 to 60 months interest only. And as mentioned earlier, we have a strong presence in the market, and adding these properties will increase payroll efficiency and synergies. The market surrounding each facility has high occupancy, and most of them have higher rents. And so this is going to allow us to increase our rates to market and increase our NOI. We also will be deploying many improvements and rebrand the properties to drive traffic and increase NOI, and thereby increasing valuation at all the facilities. So let's talk about the investment. The investment hold period is projected at 5 years. Spartan is raising $37.5 million for the investment, and our minimum investment is $50,000. The investment has a preferred return of 7.5%, and a $50K investment projects an annual return of 17.5% with an equity multiple of 1.88 over a 5-year period. So let's talk about cash flow. Cash flow projections for a 50K investor are great. We exceed 6% cash on cash in the first year, and we exceed over 8% over the course of the investment. Investors all share in the upside from sale for a total of $93,833. That's a $50,000 return of your investment and a $43,833 profit when you combine all the cash flow you receive along the way, plus the sales upside. Spartan also offers a Class B share for investments of $2 million or more. Ownership of the project increases 20% over what a Class A investor would receive. Projections are increased to 19.5 annual return with a 1.98 multiple over 5 years. There's also projected day one cash flow and sales upside. So now I'm going to turn things over to our CFO, Ben Lapidus, who's going to talk about the market fundamentals that enable us to achieve our business plan. Thank you.
Ryan, thanks for that kickoff to the Dallas-Fort Worth portfolio opportunity. Hi folks, I'm Ben Lapidus, the Chief Financial Officer of Spartan Investment Group, and I'm going to run us through the feasibility work that Spartan has done on this. And let's talk about what Spartan actually does before we dive into the material. We look at due diligence as an opportunity to verify all the information that was presented to us by either a seller or broker as true and verifiable. Feasibility is external to the property itself. It's the market conditions that allow us to drive our business plan that produces our targeted returns in the underwriting. So first, let's talk about Dallas-Fort Worth. Our portfolio is split between Dallas-Fort Worth and East Texas. And Dallas-Fort Worth is one of Spartan's favorite metro areas in the United States, like many real estate investors. And that's because Dallas-Fort Worth was the #1 fastest growing city from 2010 to 2019 in the United States by raw number count. The 2020 census came out, and Dallas-Fort Worth was one of 10 cities that has over 1 million people in city proper. In the greater MSA, it's one of the most dynamic places, not only in the country, but in the world. Not only does it house 21 Fortune 1000 companies like AT&T, Dr. Pepper Snapple Group, ExxonMobil, Neiman Marcus, Texas Instruments, which is not just based on oil, it is a very dynamic economic landscape, but it also hosts the second number of the top 50 international companies in the world. And it's only becoming more dynamic. Inc. magazine in 2019 ranks Dallas in the top 10 hottest startup cities in America. And while Dallas-Fort Worth proper is growing, the bedroom communities around Dallas-Fort Worth are growing even faster. In 2019, I was personally driving around Forney, Texas, where we were looking at several self-storage opportunities, and there was an expected 37% population growth in that town. The next town over is Terrell, Texas, and that's where 3 of our properties are located. And we're going to own that market. We are going to own 3 out of the 5 facilities in Terrell, Texas, which is fantastic because that is going to be one of the fastest growing suburbs in the Dallas-Fort Worth metro. We also own a property in Krugerville, right next door to Denton, Texas, which is another fastest growing suburb in the Dallas-Fort Worth metro. We have a property, Big Toy Storage, in this portfolio in Waxahachie, Texas, that has several developments across the street, behind the property, all over the place. One of the fastest growing bedroom communities in Dallas-Fort Worth, Texas. We have the benefit of being in the Dallas-Fort Worth metro by being in the suburb communities, but we also have the benefit of not competing with the REITs in each of these particular locations. We love Dallas-Fort Worth metro, but even more than that, we love being in the suburbs where we can own the individual communities in terms of supply that's offered. The other half of the portfolio, 5 out of the 18 particular locations, is East Texas. East Texas is made up of 3 MSAs, Longview, Texarkana, and Tyler. All of our facilities are in the Tyler market, which is the town that is closest to the Dallas-Fort Worth metro, which makes operational efficiencies between the 2 markets more attractive. Spartan already owns 5 assets in Tyler and Longview, Texas, and we've had exceptional results. In fact, our fastest growing lease up in our portfolio is in Longview, Texas, just the next major town over from Tyler. It's a successful market because it is a hub for manufacturing, transportation, healthcare, distribution, and food processing operations. It sits perfectly on the NAFTA corridor between Canada and Mexico for goods to travel between the 3 countries. All 14 locations with their 4 satellites are between Dallas-Fort Worth Metro and the East Texas Metro, which are neighboring to each other. But within those metros, the 14 properties and 4 satellites are spread across 8 counties. There's 254 counties in Texas, and 10 out of the 14 main locations are in the top 10% of net migration counties in the state of Texas, which is in the top 10 net migration states in the United States. And with that, I'm going to hand it off to Ryan to walk us through each property in the portfolio.
Thank you, Ben. I'm now going to provide a high-level overview of the properties inside the DFW portfolio. There's an expansion at 5 facilities consisting of 160,000 square feet. And even though we have the ability to expand by 250,000 square feet, we're only going forward with 160,000 square feet to be conservative. The facility average occupancy across the entire portfolio is 83%, and there's strong market occupancy throughout the portfolio, which projects day one cash flow. The existing facilities are constructed with standard self-storage construction materials consisting of metal and concrete. Overall, they're well-built structures. I'd like to just highlight the 5 facilities that we have expansion on, starting in Terrell, Texas. This property conveys with an extra 3 acres of expansion, allowing us to build at least 40,000 square feet in a market that has favorable conditions for the expansion. The next facility boasts a 99% occupancy, and Spartan is very familiar with the Tyler, Texas market, and we have 2 locations co-located already in this market. In 2020, that was one of our best performing assets in our portfolio. We plan to expand this facility by 55,000 square feet. The Flint facility has 10,000 square feet of expansion, and overall the facility has been well occupied at 92%. We plan to expand the Ferris property by 30,000 square feet in a market that, like Tyler, Texas, is well occupied at 99%. The last facility we plan to expand is in Paris, Texas. And with an occupancy of 98% and strong demand, we're planning a 30,000 square foot expansion. Page 17 of our offering memorandum also breaks down all the traffic counts, market occupancy, and expansions planned across each of the 18 facilities. And with that, I'm going to hand it back over to Ben, who's going to walk us through the underwriting of the investment opportunity.
Thanks, Ryan. Ben Lapidus here again. And folks, I'm going to walk you through the financials that mirror our underwriting file that's available on the portal for this opportunity. The first data point I want to direct your attention to is the revenue growth that we're going to achieve between year 1 and year 3. We're looking to go from gross potential rental income of $7.3 million to over $10 million in 48 months. And how do we expect to do that? There's a couple of different components to our business plan, but the first is we're going to push the street rates by 16%. And that's because we look at the comparable rents in the marketplace today based off of asset quality grade. A grade assets, B grade assets, and C grade assets. Then we look at what is going to be the grade of each of our facilities after we inject the $3.4 million of initial improvements across the entire portfolio. And when we make that comparison, we see that there is a 16% blended delta across the portfolio between where our rents should be after our quality grade improves across the portfolio and where rents are today. So we're going to be pushing our street rates by 16%. But it's not just the street rates. The market occupancy of the vast majority of these locations are 98, 99%. There is no reason why the economic occupancy should be as low as it is other than manager-operator lack of efficiency. So we're going to be increasing collections by 32% in the first 24 months. That doesn't mean that we're going to expect to be able to increase street rates 32%. That just means that we're going to get rid of the discounts, we're going to get rid of the delinquencies, we're going to get rid of the friends and family people who are there paying 30, 40, 50% less than some of their peers who are paying street rates today. And in addition to that, we're going to also increase the street rates by 16%. So that's part 1 of the business plan. It's operational efficiencies. Get to a point where our asset quality grade can demand the extra 16% plus on the street rates and increase our collection such that the overall revenue growth on the existing supply is close to 32%. Part 2 of the business plan is to take advantage of the 250,000 square feet that we could improve upon. However, we've looked at the markets across each of the 14 major locations and assessed not every facility should be improved upon with additional supply. Just because we have the land doesn't mean we should build the additional supply. So there's 5 locations that we've determined that not only do we have the space to expand, but we also have the market conditions that are ripe for expansion. And those 5 locations, we've determined 160,000 square feet, at least to start with. But that's what we underwrote, 160,000 square feet. We believe that we can achieve that with a very high level of confidence. That 160,000 is going to make up half of the additional revenue that we're going to be achieving between year 1 and year 3. So yes, it is a 50% gross potential rental income growth in 24 months, but it is achievable by way of the market conditions on our existing supply and by adding new supply of 160,000 feet. That is almost a 20% increase to the supply today. The second data point that I want to draw your attention to is the debt service. The debt service coverage ratio or the debt yield, depending on what you like to look at, are two of the best metrics to look at in terms of risk. Banks like to see a debt service coverage ratio of 1.25 to 1.3x of NOI. That means that you can cover your debt service and still have a cushion of 0.25, 0.3 left over on top of that debt service. An extra 25% or 30% in excess of the cost of your debt is profit, at least. Banks want to make sure that you are profitable with the debt service. In our first year, based on the terms that we're anticipating, we expect to have a debt service coverage ratio of 2.1. And that's only going to grow from there. If we maintain an IO period in year 3, the debt service coverage ratio is going to be over 3, much, much better than the 1.25. And even if we have a conversion to an amortized payment in year 4, we're still looking at a 2x debt service coverage ratio by that year. However, based on the conversations that we're having right now, we believe that we're going to be able to have an IO period for the entirety of the hold period of 5 years, but we underwrote a IO period of 3 years. We are targeting a rate of 3.25% and to include the construction component at 70% loan to cost. Our primary course of action is to achieve a 3.25% interest rate on 70% loan to cost on all of our items. That includes the $88.5 million of acquisition, the $3.4 million of initial improvements, and the $9 million plus in construction costs for the 160,000 square feet of expansion. The final data point I want to call your attention to is property taxes. Spartan has a lot of experience collaborating with multiple counties in the state of Texas and leveraging the laws built around equitable property tax assessments to make sure that we have the best outcome. So we feel very confident when we look at our competitive property tax dollars per square foot in the market to determine what our property tax increase is going to be. And so we've conservatively estimated that the property taxes blended across the portfolio are not likely to be higher than 40 to 50%. But we've underwritten a 59% increase in our portfolio property taxes to be achieved in month 18 of this portfolio. So we're underwriting an increase to the property taxes pretty early on in the portfolio. And we believe that this is fairly conservative given the conditions of what we've assessed across the competitive landscape in each of the different 8 counties. So walking through what this means for each investor, a Class A member has a minimum investment of $50,000. That's going to earn them an ownership amount of 0.0775% per $50,000. For Class B members, the minimum investment amount is $2 million, and the ownership for $2 million is 3.72%. That is a prorated 20% equity kicker relative to Class A members, but both classes have the same preferred return of 7.5%. The total operating returns on every $50,000 investment for Class A members is $20,106 and $23,726 for the sales side, the liquidity event. So almost a 50-50 split between the two. The total return works out to 17.5% annualized over a 5-year hold with an equity multiple of 1.88. On the Class B side, it's $815,000 total operating returns for a $2 million minimum investment with a liquidity event upside of over $1.1 million. So a little bit more weighted to the sales upside due to that equity kicker. But it works out to a annualized return of 19.5%. So by investing a minimum of $2 million, there is a 2% additional return for Class B members relative to Class A for an equity multiple of 1.98x, almost a doubling of your money in 5 years. And of course, we always like to look at what is our worst and our best case scenario. We can't guarantee that the returns are going to fall between worst and best case, but we have a very high level of confidence given our historical performance that we've experienced over the last half decade in self-storage to produce a range of returns. So while we're targeting a blended return between Class A and Class B of 17.9%, we have a high level of confidence that the returns are going to fall between 12% in our worst case scenario and 25% in our best case scenario. And the variables that change between the worst case, the best case, and the likely case scenario are some of the more meaningful ones. What's our assumed cap rate? What's our assumed rent growth? What's our assumed hold period? What's our assumed lease-up rate on the expansions? The major variables are considered in determining the likely worst and best case outcomes. And with that, I'm going to pass it back over to Ryan to take us home.
Thank you, Ben. I wanted to thank everybody for watching the webinar, and I'd also like to introduce you to our investor relations team here at Spartan. Ted Green, Lauren Breichel, and myself, Ryan Gibson, are available to answer any questions you have about investing or on your current investments. The next steps are to log in and subscribe to the offering. If you need access to the investor dashboard, please reach out to one of us by emailing investors@spartan.com. at spartan-investors.com. From the dashboard, you'll find all the documents pertaining to the offering and have the Start Investment button to start the subscription process. Well, thank you, everybody. We have our entire executive team on the webinar this evening to go over live questions. If you have any questions, please put them in the Q&A window or send a comment. Thank you. Okay, thanks again, everybody. We're going to go ahead and start with the first question for Ben Lapidus, our CFO. And what is the acquisition and projected disposition cap rates?
Thanks for the question. The acquisition cap rate based off of historical data is, 5%. We're seeing cap rates compress around the country, 4.5% to 4.7% for portfolios like this. And our disposition cap rate is assumed at 5.35%. So even though our thesis is continuation of compressing cap rates in the self-storage space, we always like to underwrite an expanding cap rate.
Thank you, Ben. How many self-storage facilities does Spartan currently operate? 24 is the answer. What is the exit strategy for 18 properties? The exit strategy at Spartan is to roll all of our self-storage facilities into the FreeUp Storage national brand, provide the brand standards, expand the properties, lease up the facilities, and eventually we want to roll this portfolio up for a sale. And we project that sale to be either a bucket of Class A and larger facilities to a more institutional REIT type of buyer, like a Blackstone, or we're going to break up some of the smaller, less desirable locations that REITs don't care to buy in, and we are going to sell that off in a smaller portfolio. Alternatively, we could break up this portfolio into smaller properties and larger properties and sell them off piecemeal, or we could sell this portfolio simply as we projected at a little bit of a higher cap rate than we bought it for conservatism, to a buyer that's national like us or a local buyer. Is there any depreciation is the next question, and there absolutely is. If you look on the offering memorandum, I believe on page 5, it gives an estimated depreciation schedule, and we expect to take bonus depreciation after we do a cost segregation study for the tax year 2021. We are projecting that you'll have a pretty significant loss in the first year due to the benefits of bonus depreciation. Next question will be one loan for all properties or multiple loans? And the answer is one loan for all properties. We have a lender that's going to finance the entire thing. Okay, the next question I can take, can you provide some color on the free cash flow distributions from operations will flow? Does the Class B investor get distributions first before the Class A, and then split with the sponsor on what's left? The answer to the first part of your question is the distributions go equally, and the investors, both Class A and Class B, get a distribution of 7.5 for the first 7.5% of your investment in the preferred return, and that goes equally pro rata based on your ownership. So one doesn't get it before another. And after that, if there is a cash flow that exceeds the pref of over 7.5%, then it would get split with the sponsor, and the splits are listed in the PPM. So 70-30 split for Class B, and I believe it's about 60-40 for Class A.
Quick clarification, the preferred return is pro rata based on contribution amount, not based on ownership, but then the splits are based on ownership after the preferred return.
Did you purchase all 18 facilities from the same seller, or were there multiple sellers? And the answer is one seller. Is the 7.5% preferred return cumulative? Yes, it is. It is cumulative throughout the course of the investment, and will be made up, if not hit, at the end in the sale if there's enough profit to pay off the preferred return that accumulated. In addition to storage, are there opportunities for additional revenue, U-Haul, rentals, etc.? The answer is yes. There is, I believe, over 30,000 square feet of office. There's over 500 parking spots. We will deploy U-Haul at many, if not all, storage facilities. And can you guys remind me how much warehouse there is? Do you guys remember off the top of your head? Okay, we'll get back to that, but there is warehouse space as well, and it's fairly significant amount. Is there a Ben, this one is for you. Is there a prepayment penalty on the loan?
There's about 52,000 square feet of non-storage, non-RV park. So 52,000 square feet of anything that's not storage in the portfolio. And then the question was prepayment penalty on the loan?
Yes.
Yeah. So we're still negotiating the loan. All loans have some type of exit fee. So if the question is more around, is this prepayment penalty going to be yield maintenance? The answer is no. We are looking to ensure flexible exits with the opportunity to have releases on recourse, releases on the collateral for the loan. So we're going to be closer to a step down exit fee than anything having to do with yield maintenance.
Okay. And the next question I have is the 7.5 preferred return compounded? And the answer is no. It is cumulative, but it doesn't compound interest. Have the additional revenue sources been included in the underwriting, or is this bonus revenue? Ben, do you want to take that comment or question?
Yeah, so we do our best to predict the ancillary income in the underwriting, but for the most part, we try to stick to what the current operator is achieving. So any additional revenue line items are not accounted for, but growth in the existing line items are.
I also wanted to point out there is 250,000 square feet of expansion potential, and we've only underwritten 160,000. So there's similar to the Tyler Longview portfolio that we purchased in 2020, there's significant upside that's not represented potentially in the underwriting file. When you start the expansion at the 5 locations, you have targeted for, when will you start the expansions at the 5 locations you've targeted for expansion? Ben, do you want to comment on when, kind of how we, nothing happens, obviously, day one economically, we start preparing the construction, but in the underwriting, we plan for not only a delayed start on the construction side, of maybe a couple of months, but also we give time for that facility to lease up in the underwriting. Do we know when we are planning on starting construction on the 5 facilities?
Yes, we do. So the underwriting, we blend the assumed construction starts and the assumed delivery dates. So we're assuming the construction will start around month 8, and the blended delivery date across all 5 expansions will deliver in month 22. We usually like to make sure we have at least a year to deliver on our assets. So 22 is on the conservative side.
Scott, you can back me up with this answer. I'll try to take the first crack at it. How have recent labor and material shortage affected expansion timelines? What we're seeing is the timelines haven't been impacted as far as I'm aware, but obviously the costs have been considered and underwritten accordingly. So costs have increased on steel, and costs generally have gone up, but we've accounted for that in the underwriting. Scott, can you add a little bit to that?
We have seen some delays in timelines as well. We're getting hit like everybody else. So it's one of those things that it hasn't been significant. It's been a couple of months. So it absolutely has. To try to predict what's going to happen in the future, it's going to be really hard.
Ben, this question is for you. What is the ratio of climate to non-climate controlled for the current units? And then what is the ratio for the planned expansion?
So for the planned expansion, we actually underwrote on a construction costs basis. We assumed 100% climate control, but we did a blended climate control, non-climate control on the rents side, again, for conservatism. So 100% climate control on the expansion. On the existing, actually don't have that number. So I'm going to circle back before we end this webinar with what the percentages of existing climate control to total square footage.
Okay, next question. Is there a co-sponsor or equity co-investor in this deal? And the answer is yes. All principals invest in the deal, to include employees and the sponsors of the project. Can we give the characteristics of the seller?
It's a mom and pop. So, and they're selling because they've made the life choice to just dispose of the asset and move on to retirement.
Okay, next question I can take. What is the closing time frame for all 18 properties? And the closing target right now is September 30th. I also wanted to add one more thing to the exit strategy, is that we're considering the establishment of a core asset fund at some point where we could consolidate our own portfolio into a new fund that Spartan manages.
The exit strategy is the most exciting part with the kind of the consolidation and storage. There's so many things that we can do with kind of the portfolios that we're buying, because this stuff's coming in from core plus to, opportunistic. So we really can craft multiple different lines of effort for those exit strategies.
Yeah, the storage is cap rate compression, 12% annual rent increases since 2020. And we're in a great position to buy an awesome portfolio. Next question we have is, in your current experience in the DFW and Tyler Longview areas, what are the differences in demand between climate and non-climate controlled? I'll take a first stab at it if you guys want to jump on. Texas doesn't have basements and the attics are full of humidity. So storage for climate controlled is in high demand in Texas. We're seeing a very rapid lease up rate in our climate controlled facilities in Texas. And in Tyler specifically, there really isn't any available units in the climate controlled. So that's a great market to have climate controlled facilities. Pricing difference is substantial. It's a bit more for climate controlled versus non-climate.
When you look at DFW and you look at Tyler, you have two different climates there. Tyler Longview, basically for all intents and purposes, is Louisiana. So it's very humid there versus much drier climate in DFW. So, and it really kind of depends. People do love drive up units. And it's actually one of the things that we're considering is looking at figuring out how to effectively, I should say cost effectively, convert some of our standard drive up units to climate controlled drive up units with insulated doors and some integrated HVAC stuff through there to kind of offer a premium unit, which we're kind of seeing from some of the major players in the market to do that. So we have some, we're looking at adjusting some of our current properties there, and same with this one here. So it really is a blend of having both on site.
I just want to jump in and say that the existing supply is about 10.6% climate control.
Okay. The next question is, will there be a replay of this webinar available? And if so, where will it be? And the answer is the webinar replay will be emailed out to everybody. It'll also land on the investor dashboard in the deal room area. So if you go to Spartan-investors.com, you log in, you click on open investments or my investments. If you've subscribed, you'll see a link to the webinar replay. It's also available on our YouTube channel, and a copy of the webinar has already been uploaded to the channel, and this Q&A will be appended after the webinar to that Spartan Investment Group YouTube channel. Addie, yes, there is personal investment into the project. Next question is the 5-10 mile radius population growth and median income available for each property, and the answer is yes. That's on page 17 of the offering memorandum. We break down vehicles per day, demand, market occupancy, facility occupancy, and intention to expand on page 17, property by property, location by location specifically. There'll also be a feasibility study posted in the next week that will also be on your dashboard that you can download that's more comprehensive than that. But that page 17 of the offering gives you a very good idea of the each property. Do you have any institutional investors investing in this deal as a sponsor / passive investor? The answer is no. There is no institutional equity in this project that I'm aware of. We'll do one more question. Do you foresee an impact in storage unit demand due to potential impact of COVID due to less discretionary funds? Quite the opposite. We've actually seen a large increase in occupancy and a 12% increase in rents. Great. I'll just conclude with saying that for the webinar registrations that we did receive, we did make sure that you guys were invited to the investor dashboard. We will, that was sent to your inbox early this morning. Otherwise, if you have a login, that's where you can log in to learn more information and subscribe. All right, great. Thank you so much, everybody, for attending this evening's webinar, and let us know if you have any questions. Have a great evening, everybody.